Welcome to Total Convexity, a weekly financial podcast that caters to professional finance individuals, high net worth investors, family offices, and other sophisticated financial professionals. Join our hosts, hedge fund manager Jim Wang and Henrik Neuhaus, as they explore the interconnected world of global macroeconomics, central banks, and capital markets. Comprehending the intricate web of global macroeconomics, central bank policies, and capital markets isn't just an option, it's a necessity. Whether you're a chief investment officer, financial analyst, entrepreneur, or simply someone curious about how the global economy and capital markets function, this podcast serves as your compass through the intricacies of the global financial landscape. In each episode, we will delve deep into the influential factors shaping our world, from global economic trends and central bank policies to capital markets and trading strategies. We will demystify financial jargon, clarify complex numerical data, and provide you with insights from experts in the field.
Total Convexity Episode 5 is being recorded on the 27th of October, 2023. I'm your host, Henrik Neuhaus. Joining me is my co-host, Jim Wang. I'm glad to return with the 5th episode of our podcast series. In the first episode, we discussed our investment and analytical framework, and we recommend you listeners to review the first episode, as the explanation of our framework lays the foundation for the subsequent episodes. In the past few weeks, the topics for our podcasts have been interest rates, the US dollar cycle, and last week, gold. Jim, what would you like to discuss this week?
Yeah, sure. So, hello, everyone. I'm very glad to return to the new episode. So, given the recent headlines of large fiscal deficit, and we all talk about the potential government shutdown in November yet again, and also the Fed fastest monetary tightening in the past 4 decades. Maybe it's a good time for us to discuss the joint effects of fiscal and the monetary policy, because I think they are the really drivers for the economy and also the capital market. What do you think?
I think that's a great idea. In our first episode, you had mentioned the interactions of fiscal and monetary policies and the joint effects on the economy of and their joint effects on the economy of financial assets. Could you please refresh our memory a little bit how the framework works?
Yeah, definitely. So in one of our framework is basically we look at the monetary policies and the fiscal policies, and we look at the joint effects that they have on the market and also on the real economy. So a lot of our indicators you and I build together are following these two main drivers, right? As we mentioned, the real drivers for the long-term economy is really the productivities and the population growth. But from cyclical perspective, the market and the economy and the capital market are really driven by the monetary policy and the fiscal policy. So I have this basically 2x2 quadrant for the monetary policy and the fiscal policy. In the quadrant 1 is basically tightening monetary policy, but easing fiscal policy. So when you have a monetary policy tightening and fiscal policy easing, and during that time, economy tends to outperform the financial market, and the bonds will sell out, curve will flatten. Inflation will rise, but because you have a tightened monetary policy, it will be under control. Currency typically is strong. Now, the price of a risk asset is hard to tell. It will depending on which force is stronger. So if you have a very strong monetary policy, typically the valuation will come down. But if you have a very strong fiscal policy, the revenue of the firm may continue to grow, the bottom line may continue to grow. So it's really between the balance of these two. So therefore, the sector and the security selection are very important. And typically those that are longer durations asset typically will underperform, and those shorter durations and the benefit from the economic growth will tend to benefit from that. So that's in the first quadrant. In the second quadrant, it's basically the easing monetary policy and the easing fiscal policy. During that time period, both economy and the financial market will perform well. Nearly all the financial asset will rally. You literally can buy anything. Everything will rally. And during that time, cash is trash. You do not want to sit in cash. And generally speaking, financial market will outperform economy. It was during that time inflation will rise, currency will depreciate, curve will steepen, and the long-dated treasury will underperform during that time period. They can still perform okay, right? But they will just underperform. Now, during the third regime is monetary easing while fiscal policy tightening. Okay, so basically you have easing monetary policy and you have a tightening fiscal policy. During a time period, financial asset will outperform economy. Long duration asset will underperform. So growth stocks, long duration bond will perform very well. Currency will weaken. Inflation risk really depending on net balance between these two, fiscal policy and monetary policy. So if you have very easy fiscal policy and the money, if you have very easy monetary policy, but the fiscal policy only tighten a little bit, you may have some inflation risk. But generally speaking, inflation is muted during this regime. And the final regime is really is quadrant 4, where is both the monetary policy and the fiscal policy are tightening. So during this time period, both economy and the financial asset will perform poorly. US dollar will remain strong. And typically during this time period, cash and the short-dated treasury, short-dated rates will be the best performer. And obviously, we laid out this in the simplistic form, and that the asset prices of when they're going to perform, when is a turning point, and they may not exactly happen in the let's say stock may not rally exactly at the time Fed start to ease or monetary fiscal start to respond. They typically come with a lag. So, and there is a transition time period from one quadrant to the other. So I would say there is a lot of nuances behind this grid, but this is basically our guiding post in terms of our take on the fiscal and monetary policy and generate their impact on the economy.
Okay. So now looking at the grid, the way you have laid out the grid with the 4 possible states and macro states, it appears to me that monetary policies have more impact on financial asset prices, while fiscal policies have more influence on growth and inflation. Am I right about this or not? So could you talk about that a bit?
Yeah, that's a very good observation. I would say it's partially right, and there's also a lot of nuances behind this. So first of all, when we talk about why this is the case, why during this quadrant asset will perform in this way, and the growth and the inflation will respond in from that perspective. So I think first thing that we want to understand here is what is monetary policy? What are they trying to do? So the monetary policy, typically the instrument is basically the interest rate, right? So when you lower the interest rate, you basically lower the discount rate of all the future cash flow. Therefore, you increase the net present value, right? And from that perspective, it's an instant boost to basically all the financial asset. And it is right. The financial asset will readjust, will revalue very quickly on that. And therefore, there is an outsized impact on the financial asset. Secondly, once the interest goes to zero, Fed conduct the QE time period, and that is also very positive for the financial asset. That's because when the Fed was doing QE, and the Fed is basically the lender of the last resort, but they are not spender of the last resort. Fed does not create money that you and I can go out and buy things, but the Fed rather through QE, they basically increase the bank's reserve balance, bank's reserve, and at the same time they take off the long duration treasury, and that's a net liquidity injection into the financial market. So in last episode we talked about the liquidity lift our boat. So when the Fed ways to inject liquidity into the market is basically through buying treasury. And when they buy the treasury, there is a net liquidity injection into the whole financial asset. When the treasury yield is lower, all the other financial assets will be evaluated against that, and depending on the economic situations, and the financial asset generally will benefit. The entire financial asset will benefit. The distribution between different asset classes obviously will depend on the relative valuation and their expectation versus the future economic growth, as we explained in our last episode. So therefore, the monetary policy will have direct impact of the financial market. As a matter of fact, the Fed conduct monetary policy to influence the real economy through this channel, so-called the wealth effect. And because when people feel wealthy with the financial asset, they tend to spend more. At the same time, the money also, so that will also result in the increase of economic activities. So secondly, let's talk about how the money is created for the things for us to spend on the goods and the services. Okay, so for people to spend goods and the services, obviously, in the long run is real income growth, right? But from our fiscal and the monetary policy perspective, the money is basically created by two things. One is the credit expansion, right? And the secondly is the fiscal spending. Okay, so when the Fed lower the interest rate, and debt is getting cheap to borrow, and people will start to lever up. When you lever up, that's basically create money. So when bank give a loan, you just create the money, right? When you go out and have a mortgage, you basically money was created. Now the government can create the money simply by through the government spending, or they handed out money to you for you to spend, and that will literally just create new money, right? And therefore they will have a direct impact on consumption and growth. Okay, so when you look at this grid, there is underlying economic forces and the logic behind that. What do you think, Eric?
Yes. Well, okay. Now, obviously, what I want to know is in which regime are we right now? But equally important is how did we get to where we are now? What was the path? So perhaps you could talk us through the historic regimes that the U.S. economy has gone through. Jim?
Yeah, definitely. I agree. To know the future, we need to know the present time. To know the present time, we need to know the history, right? So I have here one chart here. Basically, is the U.S. budget deficit on the top, and the Fed fund rate at the bottom. Okay, and let's just start at the post-Volcker time period. And as you can see here, you can see here typically when the Fed fund rate was lowered, that was because during the recession time period, Fed fund rate increase, that is during the economic expansionary time period. Okay, and as you can see in a budget deficit, and also the physical, the budget deficit can be a proxy of the fiscal stimulus. Obviously, the budget deficit is basically revenue minus the spending, right? So the budget deficit can increase during the recession time period by both falling revenues and increasing spending. Okay, and typically during the good time, revenue increase and the spending decrease, and then you have improved the budget. So therefore, post-Volcker time period, this basically the fiscal spending and the monetary policy, basically they work in tandem. In other words, they both tighten together and they both ease together. All right, and they both ease when there is economic recession, and they both tighten when there is economic expansion and inflation become a problem. Okay. Now, notably, after GFC, something happened, right? And that we cut interest rate to zero, and then we started the QE, right? So monetary policy, I would say, continue to be very easy after GFC. So we have easing monetary policy, right? But the fiscal policy, well, basically tightening. We have increased, the budget deficit has increased significantly, have improved significantly post GFC, right? As you remember, there's Tea Party discussions, during that time period, during the Obama administration, right? There was a lot of protest. So there is kind of a fiscal austerity, per se. And although we still have a QE, and then we have basically the Trump era, right? And that's really the time things start to diverge. So when the Trump came to power, right, we had Trump fiscal policy. Obviously, the Trump era, the fiscal policy is not through government spending, but rather through tax cut. So if you look at this graph, right, before the pandemic, right, during the Trump time period, before pandemic, right, we have unemployment rate reached the record low, right, was record low, and but our budget deficit was getting worse. At the same time, during that time period, in the Trump administration, Fed was raising interest rate. So during the Trump era, we had basically rising, we have tightening monetary policy, and we have easing, fiscal policy until pandemic hit. When the pandemic, I would say, before pandemic hit, there was a slight changes. Fed have a pivot, right? So we have still easing monetary policy, and the Fed still have a easing, fiscal policy, but Fed start to change their monetary policy, but not for long, right? Then we have a pandemic hit, and then during the pandemic time period, we all know what happens, right? So basically, we basically spend as much as we can, and the Fed basically underwrote the whole thing and monetize, everything. So then after pandemic, right, and then Fed start to tighten the monetary policy again, and we can talk about the most recent history. But the thing that I want to point it out here is that during in 2020, when the world was still in deflation, I remember in Q3 and Q4. There was a deflation fear, right? And people still, people still worry about the Great Depression, and inflation was, interest was at the bottom, and inflation was very low. But at the same time, Fed was printing money like a mad, and the government was spending money like a mad, right? And it was during that time period that we basically pointed out that we are likely going to have a very highly inflationary time period, probably comparable into 1970s. And the reason that we pointed out here is that we noticed that before this pandemic time period, we have 10 years, a decade of very low inflation. I think when the Fed started QE, a lot of people worry about inflation, and that actually prevent that from happening, because the fiscal policy was really tight. By the way, that's not only in the U.S. but also all over the world, and we can talk about that once we talk about the rest of the world as well. And the comparable is in the 1960s, then we have a decade of low interest rate, and because of that, basically people think inflation was dead, right? So in the 1960s, I think inflation time period was similar to what we had, post the GFC. And then Lyndon Johnson come out with the Great Society in 1965, right? That's the time that the U.S. basically started to develop social welfare, right? And then after that, you have a Vietnam War, and we all know Fed was basically complicit during the time for the government spending. I would say that laid the foundation for highly inflationary time period in 1970s. Obviously, there will be many other forces, but from our perspective, the logic is very simple. When we're talking about fiscal policy, will create money immediately. Okay, will create money, basically spending power and goods and services, immediately. So when you create money on goods and services immediately, and then there is an instant demand, and if your production is not keep up, I mean, you certainly for sure is going to have inflation. That's almost a given, right? So I think that's basically the time period that came upon us, and I think a lot of people were very surprised about the inflation spike, and obviously the supply chain shock, and the energy things, and the war in Ukraine, and all this exacerbate the problem, but they are not the root cause of the problem. The root cause of the problem is basically monetary inflation, which we pointed out during that time. Similar in 1970s, and people will blame the oil shock for the inflation. Again, we will say that's not the root cause. That exacerbate the problem, because the oil shock and all this, it is come from supply side. Okay, if it is not from the demand side, it's come from the supply side, it's not going to last, because it's actually served as a tightening effect. Eventually, that actually can be deflationary, because that will result in the consumption, the pullback of a consumption in all the other areas. So that basically will take us to, walk us very quickly, for the past, I would say, for decades right now. And where do you want to go from here?
Right. I mean, it's interesting, this comparison between how the Fed and the government acted during the pandemic, and the Nixon years during the Vietnam War, when he had the war was not very popular, and he definitely didn't want to raise taxes to finance it. Wars are expensive, so they ended up printing money instead. So there are some similarities there. Anyway, so this takes us to the present time. So which regime are we in right now, and where are we heading, do you think?
Yeah, so we just walked through the history, and then that will take us to the present time. And so post-pandemic, inflation came, and everyone was very surprised, and especially caught Fed by surprise, right? By the way, during that time, you probably know about this. We say, I mean, in the 2020, when I lay off the inflation time period, and people will say, oh, Fed can hike the interest rate and kill it instantly. And I will say the word that you hear most from the Fed will be transitory. It's hilarious, actually. We predict that that thing, and you just repeatedly hear them talk about transitory until it's not transitory anymore. So we basically had the fastest, tightening of monetary policy in the past 4 decades, right? As you know, Fed was basically hiking interest rate in a rapid pace, but at the same time, the fiscal policy and continue to be very strong. And as Biden, so-called Bidenomics, right? He pushed through a lot of the kind of a spending bill, such as the CHIP Act and Inflation Reduction Act, and maybe it's the Inflation Acceleration Act, and also green bill, and etc. Right? So that's the regime that we were in, and that it was basically tightened monetary, monetary policy, but the fiscal policy continued to be strong. And that's why we had pretty strong economy. I mean, nominal economy, significantly outperformed on the financial asset. And the financial asset basically didn't perform well. If you add a bond, if you just put a bond and equity and everything together, all of them, have declined. Okay, and with the bond being the worst performer, and the equity has declined as well, but mainly through the PE ratio adjustment. So this is a very, this is a classic in the grid that we illustrated. By the way, from the hindsight, judging this is actually very, very difficult. We were actually wrong-footed by the amount of fiscal stimulus last year. Okay, although we correctly pointed out the physical the monetary tightening effect. But in any case, if you look at the grid that we have here, this is exactly followed at a print. Basically, economy outperformed the financial market. Financial market didn't perform very well, and there is a giant kind of a sector dispersion between them. And if you look at it, the best performer is basically the energy sector. So I would say that's the time period we have been in, right now. Predicting the future is always very difficult, but that's our job. And we think the monetary policy will continue to be very tight because remember, they want to be tighter, higher for longer, right? I do think we probably already have the last, interest rate hike. I think we probably are done. But if inflation is falling, and even with nominal interest rate at this current time, real interest rate will start to rise, and that will continue to create a tightening effect. Especially if inflation come back, if asset price, stock price continue to be very elevated, and certainly if inflation reaccelerate, and I do think that the Fed will not hesitate to tighten monetary policy again. So from that perspective, I would say monetary policy continue to be tight and tighten, and the direction is tightening further. Now, from the fiscal policy perspective, I would say most of the spending bills are behind us, and I know some of them are long term, but from change of the fiscal policy perspective, it's basically we're winning and to be neutral at the best. Obviously, this can change, right? So we have a war here. First in Ukraine and now in Middle East, and who knows what's going to happen next, right? And I think the fiscal response is much faster than before. We basically have a fiscal spending to deal with all the problems, right? And even inflation problem. If inflation problem is too much spending, but even inflation problem, they will spend more to deal with inflation, right? So I would say, we obviously are open-minded to the coming fiscal kind of the policy changes, but I would say this is a great uncertainty, one of the big risks for us to handicap which regime we are in right now and are likely to head into. But I think based on the current assessment, we think we are going to head into the next regime is basically we will have the higher. Let's go back to the show this grid from we're transitioning into basically regime 1 into regime 4, and from tightening a monetary policy of easing tightening monetary policy, easing fiscal policy, right, into regime 4, which basically both of them are tightening, or basically fiscal engine, neutral at the best. So during this time period, economy will perform poorly. I think that's probably the environment we're going to head into. The U.S. dollar will become strong, and the cash and the short in the treasury are the best performer, which have been, which we probably will be, and then gradually that that will take our present time, right? And then gradually, I think we will head into, we'll head into recession. Growth will fall further until we will have a recession. During that time period, I think the stock will perform very poorly. Inflationary asset probably will not perform well, and at the same time, the bond anticipating the Fed easing, right? And in a bond treasury will become, the U.S. rates will become the best performer during the disinflationary recession period. right? And after that happens, right, once the asset price have fall a lot and inflation comes down, unemployment goes higher, stock market drops significantly, and I think Fed will cut interest rate, and obviously fiscal response will come out, and then I think that then we will transition into the regime too, basically easing monetary policy, easing fiscal policy, and during that time, during that time you can buy stock again. They will probably rally, especially inflationary asset. I think after the next cycle, I think inflationary asset will perform very well upon next cycle. Okay, upon next inflation cycle. I think current inflation cycle is over. Okay, and then the currency will depreciate again, and then we will have a repeat of a post-pandemic time period. Probably more violent, and then I will explain a little bit why. And the reason for that is because the current time period, we are not, we have a resemblance of, our inflation have a resemblance of 1970s, right? So we have an inflation. But the problem is during the 1970s, our debt level was very low. So if you look at the debt level here, this is a U.S. debt to GDP ratio. And we look at 1970s, right? The debt level in the United States is below 40%, and now it is above 100%. So therefore, and the whole system of leverage is completely different as well. And that's why Volcker was able to raise the Fed fund rate to 21%, right? And that obviously resulted in the recession and the decline of the asset prices. And with the current leverage that we have, and it's very difficult for us to raise the interest rate significantly higher. Something will be broken a lot easier, a lot sooner than that. And then in the 19 and at the same time we have the budget spending at the historically lower level, right? So we have inflation that is comparable in 1970s, right? But we have a debt level is comparable to the 1940s, right? And that is during the wartime, right? And remember during the wartime that, from 1942 to 1951, basically we had the yield curve control. So the Treasury bill was basically pegged to 3/8%, and the 10-year is basically pegged below 2.5%. Okay, so that is almost a decade of yield curve control. So what I'm trying to say here is that we will have yield curve control, and QE will come back upon next downturn. Okay, and it's not a question of if, but it's a question of when. But of course, navigating, going through that is very important, right? So in order to understand that, I think we need to understand the reaction function of the fiscal. We need to understand the reaction function of the fiscal authority and the monetary authority. So just remember, they are not doing what is right, what you think is right, okay, or what they think is right. Nor are they doing what for the long-term benefit of what is right. By the way, that is also subject to debate. Different people have different opinions. But basically, the fiscal part, the monetary policy, the monetary response is basically to deal with the immediate pain, because they have a due mandate, which is basically inflation and growth. So if growth become a problem, unemployment become a problem, recession is a problem, then they will have to ease. There is no other choice, regardless of what you think, what is right or wrong for the long run. And if the inflation is a problem, okay, they will deal with inflation. That's the pain. Regardless of what you think, the action you take is detrimental, whatever, right? It's subject to debate. But kill that pain, or the pain will kill you, okay? So that's the central bank reaction function. Now, the fiscal reaction function is also very simple. Politicians want to win the vote, okay? So basically, they want to spend money and they do not want the others to spend money. Basically, I can spend money, but not you. Okay, so they all want to spend money. Politicians, they all want to spend money. And also another difference is that Republicans want to collect less money from the people who vote for them. The Democrats want to spend more money for the people who vote for them. All right. And during the good time, right? And they still want to spend, but they at least have a check and balance. I can spend, but you cannot spend. So during the good time, the urge to spend is less. And during the good time, during the bad time, you cannot even see you cannot spend. They will tell you so bad, and you are a better person if you don't allow this to pass. So they basically say, okay, you can spend, I can spend too. So everyone spend. Okay, and that is unavoidable when you have a downturn. So I heard a lot of people saying, Fed learned the lesson, they will not do the QEs. Fed learned a lesson, they will not cut the interest rate back to so low again. I know they do not want to. Nobody wants to do that. But if you lower the interest rate all the way down to 3%, 2%, still things doesn't work, you probably want to lower more. And if that lower a lot still doesn't work, you probably want to do more. And then what can you do? You have to do QE or yield curve control again, okay? Or similar, or different nickname, right? So I think that is unavoidable. You can also hear fiscal horse basically saying that we cannot spend this, otherwise we are on the way of no return. But when the recession hit, you will spend, okay? There's just no choice. And even with the economic, situation so good, we can still not basically rein in the spending. But as I say, forecast the destination is no use, the destiny. The most important thing is to navigate through the sequence. The sequence here is this, is that Fed will tighten the monetary policy until something breaks when we have recession, and then they will start, and then I think we will have a fiscal response, and we will have a monetary response, and that will lay an inflationary time period, probably worse than we have seen in the past 2 years. So that's kind of what we see here, and looking ahead.
Right. Well, that's a lot. So now this framework that we have is a general framework. It's not specific to the US. So if you applied it to Europe, well, what would it look like?
Yeah, definitely. So here I put the same chart here. EU, basically this is European budget, and the white line on the top, and the ECB policy rate at the bottom. And like I said, they typically work in tandem. If you can see here in the 2020, 2023 to 2028, 27, we basically have a 2027. We have a rising kind of interest rate in Europe, and the budget situation was improving in Europe as well. And then during the pandemic, we have enlarged the fiscal deficit, and then we have kind of easing kind of a falling interest rate. Then something after GFC, something happened. If you look at the blue line here, right, we have basically interest rate close to the bottom, but keep falling to the negative area. And then we have, ECB started QE, right, basically, pushing, easing the monetary policy much further. But during that time, we have austerity in Europe, right? And the European, we know there is a, European debt crisis post, after the GFCs, and the periphery want to spend, but then the German will, the core countries will not allow it. That's because within their kind of in the framework, they have a monetary union, but they do not have a fiscal union, right? So it's very difficult for them to have a fiscal stimulus across the countries within the setup they have. But this changes dramatically during the pandemic time period, right? I would say what saved Europe last year, October, is because of a Russian war that result in the high energy cost, and Europe basically push out kind of fiscal stimulus again, basically by handing off the money to the people to support to help them to deal with high energy cost. So that was supporting the European strong rebound since October last year. Fiscal responding is basically very quick. It comes and goes, and when it's gone, it's gone. Okay, they do not have a sustained effect because they do not result into the long-term improvement of productivity. Therefore, they are basically a short-term impulse, and we think that the impulse is over. Okay, in Europe, so you have continued tightening monetary policies, and then you have a fiscal policies, and it's kind of tightening, similar like in the United States. And looking forward, I would say because of the war in Ukraine, and also because of the green kind of the green energy initiative in Europe, and the urgency to create inflation infrastructure, and I would say I can foresee the fiscal spending in Europe to increase as well, and so I can foresee the fiscal spending in Europe to increase in the future. All right. Now, if we move into Japan, I would say, like we mentioned, it's they also typically follow the market cycle. They both tighten and easing at the same time, and this also change during the after GFC, and Japan basically aggressively ease, and they started QE, right? And they were doing they are basically probably the worst offender of the QEs. But if you can see from the from 2009 and all the way to 19 and 20, Japan's budget has increased significantly until it blew up again, like any other countries during the pandemic time period. And the Japanese asset has been performing very well, and at the expense of currency, obviously. And that's because it's the only countries where they were still running very easy monetary policy. They were still doing the record QE, as well. And I can also see that their fiscal attitude is changing as well because of the defense, kind of they increase the defense spending as well. And because of the debt GDP level in Japan is at such a high level, and Japan is probably will on the permanent path of yield curve control. They cannot relent. I also think that they probably now a lot of people bet that Japan will may increase or basically tighten monetary policy or relinquish the yield curve control, or maybe I think that is just not possible. Okay, because of that to GDP level they have. I'll even think that they passed the best windows to basically raise the interest rate. And when the Fed was aggressively raising interest rate, I think that's the window of opportunity for Japan to join that. And I think that Japan's best hope here is the recession comes in, and the Fed has to lower the interest rate, and that will give it a relief on the currency. So I would say Japan is on the permanent path of the monetization. Well, there will be no way back, and we will just wait until next recession where their spending will increase and the monetization will increase as well. Finally, is China. And as you can see here, the blue line is the China's budget deficit on the top, and then is the 1 year Chinese government bond yield at the bottom. Notably, China was in a great fiscal situation right before the financial crisis. And the monetary, China had a 4% interest rate before that, and that quickly changed. And China is the country who always resort into, fiscal spending to stimulate economy. As you know, China was the growth engine, after the financial crisis as they launched the huge fiscal stimulus after the subprime crisis. And after that, fiscal spending has kept spending, and that is basically driven by the fixed asset and real estate and infrastructure and etc. And most recently, as you can see here, that the Chinese authorities have been lower the interest rate gradually, and at the same time they just announced 1 trillion Chinese yuan government spending for the next 1 year, and that basically, so you are going to have probably, if you look at a major economy in the world, China is the only country basically have an easing monetary policy and an easing fiscal policy. And according to our framework, in this case, you will see the financial asset to rally and the real economy to pick up. I know everyone is very bearish on China structurally, and we are also very bearish on China structurally. And we have been bearish on China for a long period of time from structure perspective. And we can get into that in the future about what are the secular forces on that. But from cyclical perspective, I think there's a chance that for Chinese economy to recover and even Chinese asset to do well, while everyone is very bearish towards the country at this time. So I just walked through the whole world using our framework very quickly, and I hopefully give you a kind of an overview of what we, how we use this framework and what we think around the world.
Wow, great. Thank you, Jim. So we're now at the end of our 5th episode. So let me try and summarize. We have this high-level taxonomy describing the 4 possible states of tightening and easing fiscal and monetary policies. Yes, now, it appears to be simplistic, this framework, but macroeconomics is a messy business, and we do need a rational way to classify typical states of the economy. We then map how the economy and the markets tend to develop in each of the 4 states. Identifying which state we're in now and where we might be moving next is very useful for getting a sense for how different market segments could be reacting as we move forward. The question now is, where are we? Jim, you made the case that you believe that we are already transitioning from quadrant 1 to quadrant 4, where monetary policy stays tight, but fiscal policies are waning. And that this ultimately will result in a disinflationary recession. As asset prices fall and unemployment rises, you believe that the Fed will ultimately cut interest rates and there will be new rounds of fiscal stimuli. Because of the high debt level, you also believe that QE or some form of yield control will ultimately materialize, which in turn will lead us out of quadrant 4 into quadrant 2. For the markets, cash and short rates are the best investment choices right now, and risk assets will likely suffer significant drawdowns as we move into this recession in quadrant 4. Then, as we transition from quadrant 4 to quadrant 2, during this transition, bonds should be performing quite well. But once we are in quadrant 2, equity and especially inflationary assets will start outperforming again, and bonds will perform poorly in this newly started inflationary cycle. Now, anything is possible, and difficult to predict events happen every once in a while, but at least this framework gives us some logical guidance as to what to expect and how to react. More importantly, we can always adjust our outlook based on new developments of or in fiscal and monetary policies. That's the summary.
Yeah, Henrik, that's a very good summary. You summarize better than I do. And why don't you tell us where listeners can follow us?
Absolutely. You can follow us by searching for Total Convexity in your favorite podcast app or via YouTube. Please don't forget to click on the subscription button so that you will be automatically notified when a new episode is available. You can also follow us on X, old Twitter, where we have a handle at Total Convexity. And you can email us at totalconvexity@gmail.com. Finally, you can follow our insights on Substack at totalconvexity.substack.com. We promise never to spam you or try and sell you anything or channel advertising your way. All you'll get is our honest take on the markets, rightly or wrongly, and we'll try and make it short and sweet. At least we try to. Anything else, Jim?
That's it. Thank you, everyone. If you like this podcast, we would appreciate it if you can pass along to anyone who might be interested. This concludes the fifth episode of our podcast, Total Convexity. See you next time.
Disclaimer. The information provided in this podcast is for general informational purposes only and should not be considered as financial advice. Consult with a qualified financial professional before making any financial decisions. All investments involve risks. There are no guarantees of profits, and investments may incur losses. The contents discussed in this podcast is not a recommendation for any specific investment. Past performance does not predict future results. The opinions expressed by guests on this podcast are their own and may not necessarily reflect the views of the hosts or affiliated parties. The podcast host and guests may have financial interests in companies or products discussed, and listeners should be aware that the opinions expressed by guests and their hosts may reflect biases. We strive for accuracy, but financial information can change rapidly. The content may not always be up to date or complete, so verify information independently. This podcast does not offer legal or regulatory advice, and listeners are responsible for ensuring that their financial decisions comply with applicable laws and regulations. Mentions of specific financial products or services do not constitute endorsements. Perform your due diligence before engaging with any financial offering. Listeners are fully responsible for their financial decisions, and the podcast's guests, hosts, and affiliated entities are not liable for any financial losses resulting from actions taken based on the provided contents.